Hi, in this problem we are asked to apply the lower of cost or market rule to valuing inventory. The lower of cost or market, also called net realizable value, rule states that when the value of inventory falls below its recorded costs, the generally accepted accounting principles require that inventory be written down to its lower market value. The value of inventory can fall below its recorded cost for two reasons. Either it's easily be replaced by identical goods at a lower cost, or it's become outdated or damaged. What we have to do then is pick whichever is lower, the original cost that we paid, or the new market, also known as net realizable value per item. So in our necklaces, first of all, the Jewel Fool had the following inventory items on hand at the end of the year. The necklaces originally cost the company $75 each, but now those same necklaces could be bought on the market at $70 a piece, so they've depreciated in value. We then have to report them at their lower market price. Their inventory has suffered a loss, and we are using conservatism in reporting them at their lower value. So $70 times 10, the total reported on the balance sheet then would be $700 for the necklaces. That means that they will be written down $5 each, from 75 down to 70. The total write down on those necklaces will be $5 each times 10 items, or $50 for the necklaces. Now let's look at the bracelets. The bracelets originally cost the company $40, and those same bracelets now would cost the company $60. So the rule states that we have to report at whichever is lower, cost or market, and in this case, the original cost is lower. They will remain in our inventory at $40 a piece, times 50 units, a total of $2,000. No write-down is required for the bracelets. Let's add up the total that should appear on the balance sheet. 700 plus 2,000, a total of $2,700 will go on to our balance sheet. So the inventory will suffer a write-down of $5, a drop from 75 to 70 for the necklaces, times 10 necklaces. Now, what is the effect on our cost of goods sold and net income? Let me show you the journal entry we would do. We would debit cost of goods sold for the $50. Type up here, debit. And we would credit the value of our inventory. So that will reduce the inventory by $50, and it will increase the cost of goods sold. Remember that cost of goods sold is subtracted from sales revenue to give us gross profit. If the cost of goods sold increases by $50, then the gross profit and net income will decrease by $50. So the effect on net income is that it will decrease our net income dollar for dollar by the amount of our inventory write-down.